In 2022, one number quietly moved. Nobody announced it. Nobody warned regular people about it. There was no headline saying, "Your life is about to get more expensive." But within months of that number moving, mortgage payments across America jumped by over $1,000 a month. The stock market lost nearly $20 trillion in value. Hundreds of thousands of people in the tech industry lost their jobs. Companies that were hiring froze. Companies that were expanding stopped. And millions of people who had been saving for their first home, people who had done everything right, suddenly found themselves locked out of the market they had been planning for years to enter. That number wasn't the unemployment rate. It wasn't the price of oil. It wasn't even anything the president or the Federal Reserve said. It was a bond yield. And here is what makes this terrifying. Most people have no idea what that means. Most people don't even know this number exists. Yet it touched their mortgage, their job, their retirement savings, and their ability to buy a car, all in the same year. Later in this video, I'm going to show you exactly why the world's most powerful investors call the 10-year Treasury Yield the single most important number in all of finance. And I'm going to show you how understanding just this one concept could change every financial decision you make from this day forward. But first, I want to introduce you to someone. Meet James. James is 34 years old. He lives in New York City. He works a solid job, makes decent money, and has been saving carefully, patiently for 5 years. His one goal: buy a home for his family. In 2021, James ran the numbers. The mortgage payment on the home he wanted was $2,100 a month. Tight, but manageable. He could do it. His dream was finally within reach. He didn't buy immediately. He waited a little longer to save a slightly bigger down payment. Responsible. Smart. Exactly what financial advice tells you to do. In 2023, James ran the numbers again. Same house, same neighborhood, same dream. The mortgage payment was now $3,400 a month. James hadn't gotten poorer. He hadn't lost his job. He hadn't made any bad financial decision. But his dream had moved $1,300 further away every single month because of something he had never heard of. Something nobody in his life had ever explained to him. We're going to follow James through this entire video. Because what happened to his mortgage is just the beginning of how bonds affected his entire financial life. His investments, his job, his savings, every part of it. But before we can understand what happened to James, we need to understand what a bond actually is. And I promise you, this is going to be the simplest explanation you've ever heard. Here's something most people never think about. Governments need money. A lot of it. Every single day. To build roads, pay teachers, fund hospitals, run the military, handle emergencies. And no government in the world can always cover these costs just from taxes. So what do? They borrow. Massively. Constantly. From the entire world. They go to banks, to other countries, to pension funds, to regular investors like you, and they say, "Lend us money. We'll pay you back with interest." In return, they give the lender a piece of paper, or today, a digital record that says, "We owe you this money, and we'll pay you regular interest until we pay it back fully." That piece of paper is called a bond. Now, here is your first jaw-dropping moment of this video. The total value of bonds in the entire world right now is over $130 trillion. The entire global stock market, the one everyone obsesses over, the one everyone watches on their phone, the one that fills financial news every single day, is worth around $100 trillion. The thing nobody talks about is bigger than the thing everybody talks about. This is not a small, dusty corner of finance. This is the largest financial market on planet Earth. And yet, almost nobody teaches regular people how it works. Now, let's talk about the number at the heart of it all. When the government borrows your money through a bond, they agree to pay you interest every year until they pay you back. That interest rate, the return you earn, is called the yield. Think of it like the rent the government pays you for using your money. Simple so far, right? Here is where it gets interesting. Here is where James's mortgage starts to make sense. Most people think mortgage rates are set by banks. They're not. Most people think mortgage rates are controlled by the government. They're not. Your mortgage rate is almost entirely driven by bond yields. And here's the part that even surprised many Wall Street analysts. Bond yields often move before the government announces anything, before the Federal Reserve raises rates, before any official decision is made. The bond market moves first, and the banks follow. And James and millions of people like him pay the price without ever knowing why. Let me show you exactly how this works. Here is the most important relationship in all of finance. Bond prices and bond yields move in opposite directions. Now, I know that sounds confusing, so let's make it as simple as possible. Imagine you lent your friend $10,000. He promised to pay you $500 every year for 10 years, then return your $10,000 at the end. That $500 per year is 5% of $10,000. That's your yield. Now imagine your friend becomes less reliable. Maybe he loses his job. Maybe people hear rumors about him. Now other people don't want to buy your loan from you at full price. They'll only offer $8,000 for it. But your friend still owes the same $500 every year. The payment didn't change. The price you sold for changed. So now the new person paid $8,000 but is still receiving $500 per year. That's actually a 6.25% return, now not 5%. The price fell. The yield rose. This is why when people panic, when they sell bonds out of fear, prices drop and yields shoot up. And when yields shoot up, every single bank in the country looks at that number and adjusts mortgage rates upward, because banks use government bond yields as their baseline for what to charge you. In 2022, the 10-year Treasury yield went from around 1.5% to over 5% in less than 2 years. That single move in one yield number caused mortgage rates to nearly double. It caused the stock market to drop trillions. It caused the most aggressive housing market slowdown in modern history. That is the power of bond yields. And James felt every single bit of it. Most people, when they hear the economy is struggling, think, "Oh, the stock market must be crashing." But here's the contrarian truth that Wall Street insiders understand. The stock market doesn't lead the economy. It follows it. The bond market is what leads. Bond traders are not emotional. They are institutional. They are cold and calculating. They're managing pension funds worth hundreds of billions. And when they start selling bonds when yields start rising, it means they believe something dangerous is coming. Long before a recession officially arrives. Long before the news reports layoffs. Long before your company freezes hiring. The bond market already knew. In fact, here is one of the most reliable economic warning signals in history. It's called an inverted yield curve. And every time it has appeared in modern history, 1990, 2001, 2008, 2019, a recession followed within months to 2 years. Most people had never heard of this signal. The bond market had been screaming it. Now let me show you the psychology behind all of this, because this is where it gets deeply human. In September 2008, Lehman Brothers, one of the most powerful banks in the world, collapsed overnight. The next morning, investors across the globe woke up in a state of pure terror. They didn't think, "How do I make more money today?" They thought, "How do I make sure I still have money tomorrow?" In that fear, they didn't run to stocks. They didn't run to gold first. They ran to U.S. government bonds. Specifically, Treasury bonds, because in 200-plus years of American history, the U.S. government had never once failed to pay back a bondholder. When you're terrified, you don't want the best return. You want the safest return. You want to know your money will still exist next week. That mass rush into bonds caused bond prices to rise. And when prices rise, remember our earlier lesson, yields fall. Suddenly, borrowing became cheaper. That cheaper borrowing helped businesses survive, helped the economy slowly start breathing again. The bond market, driven entirely by human fear, essentially began the mechanism for its own recovery. Not because anyone planned it, but because millions of scared investors, making individual decisions collectively, created a system that started to stabilize itself. But here's the other side of that psychology, and this is just as important. When the economy feels good, when people feel overconfident, when they feel reckless, they pull money out of safe bonds and chase higher returns elsewhere. Stocks, real estate, crypto, anything that promises more excitement. When money leaves bonds, bond prices fall. Yields rise. Borrowing gets expensive. Companies slow down. The economy cools. Sometimes it crashes. This is why some economists describe the bond market as the world's largest lie detector. It doesn't care about optimism. It doesn't respond to speeches or promises. It responds only to what large, sophisticated, institutional investors actually believe is happening, not what they're saying in public. When those investors are genuinely scared, bonds tell you. When they're genuinely confident, bonds tell you that too. The bond market is the most honest signal in all of finance. Remember James? We left him staring at a mortgage payment $1,300 higher than what he could afford. But that was just the beginning of how bonds affected his life in 2022 and 2023. Because while James was struggling with the mortgage, something else was happening at his job. His company, a mid-sized tech firm, had borrowed money to expand. They'd been growing, adding teams, talking about new offices, planning to hire 200 more people by year's end. Then bond yields spiked. Their borrowing costs doubled. The expansion plan? Shelved. The 200 new hires? Canceled. And then, the thing nobody expected, his department got restructured. James wasn't fired, but 3 of his closest colleagues were. His investment portfolio was next. The stocks he'd been steadily investing in for years, they'd dropped 25% in a single year. Not because the companies were bad, not because anything in their business had changed, but because when bond yields are high, smart money moves from stocks into bonds. And when smart money leaves stocks, stock prices fall. James lost sleep. James had anxiety. James, who had done everything right, felt like the world had been rigged against him. It hadn't been rigged, but it had been controlled by bonds, by yields, by a number nobody had ever explained to him. Now let me tell you what James should have known, what all of us should know, what practically nobody teaches in schools, in workplaces, or even in most financial content. Here's the truth about the wealthiest, most financially sophisticated people in the world. Before they look at the stock market in the morning, they check the 10-year Treasury yield. Before they decide whether to buy property, they check the 10-year Treasury yield. Before they decide whether to expand their business or hold back, they check the 10-year Treasury yield. Warren Buffett has said that bond yields are the gravity of the financial world. When yields are low, stocks float up easily. When yields rise, everything gets pulled back down. That metaphor is not poetic decoration. It is a literal description of what happens. And yet, most regular people, checking their investment app, worrying about their mortgage, wondering why their savings aren't growing, have never once looked at the 10-year Treasury yield. Here is what I want you to take away from this video. You don't need to buy bonds. You don't need to trade them. You don't need to become a bond expert. But you do need to check the direction yields are moving, because that direction is the single best early warning system for the financial decisions you're about to make. Thinking about buying a home? Check if yields are rising or falling. If they're rising sharply, mortgage rates will follow. Maybe it makes sense to wait. Thinking about taking a business loan? Yields rising means your cost of borrowing is about to go up. Factor that into your plan. Worried about your stock portfolio? When yields rise aggressively, growth stocks, especially tech, tend to suffer first. Understanding this protects your mental state and your strategy. Thinking about your job security? Rising yields slow business expansion. If yields are spiking, companies across your industry may soon freeze hiring. That's a signal to make your position more secure before others notice. This is not about becoming a trader. This is not about becoming obsessed with financial data. This is about spending 30 seconds looking at one number, the 10-year Treasury yield, before any major financial decision in your life. If James had understood this in late 2021, when yields were already starting to creep upward, he might have locked in his mortgage before rates exploded. He might have repositioned some of his stock investments before the drop. He might have read the warning signs at his company before his colleagues were blindsided. He didn't need to predict the future. He just needed to read the signal that was already there. James eventually found his footing. He didn't buy the house in 2023. He waited. He kept watching the signals. He learned to read the market he had always ignored. And slowly, as yields began to stabilize, he started planning again. Smarter this time. Not with hope as his only strategy, but with understanding. Here's the thought I want to leave with you today. We live in a world obsessed with the visible, the stock market, the flashy numbers, the exciting news cycle, the crypto ups and downs. But the real levers of the economy, the ones actually moving your mortgage, your job, your savings, the price of the groceries you buy, they are quiet. They are invisible to most people. They are hidden in a market that never makes the top of the news. The stock market reacts, the bond market decides. And here is the final fact I want burned into your memory. In October 2023, bond yields on U.S. Treasuries briefly touched 5%, the highest level in 16 years. In that single moment, without a single vote being cast, without a single government announcement, without a single CEO making a decision, trillions of dollars shifted. Mortgage rates moved. Stock markets dropped. Business plans changed. Hiring froze across entire industries. All because of one number. One number that most people don't watch. One number that the wealthiest investors in the world watch every single morning. The next time someone tells you the economy is controlled by governments, or politicians, or the stock market, just remember this video. Because now you know what's actually running the show. If this video changed how you see the economy, share it with one person who is stressed about money right now, because understanding this could genuinely help them. Subscribe for the next video, because we are going deep on what happens when governments borrow too much and who actually pays the price when the bond market loses trust in an entire country. That video is going to make today's feel like a warm-up. See you there.